This is Chapter 28 of our lecture, Part 1. Chapter 28 is a continuation of our decision-making chapters. If you remember last chapter, Chapter 27, we talked about lean manufacturing, lean accounting. So those are some new evolving practices that are speaking toward operational efficiency. And are part of the tools that allow us to improve the performance of our company. Chapter 28 is really kind of taking it a step further and saying, how can we measure the performance of the company, and how can we provide, through that performance measurement, how can we incent our management and employees to achieve the goals that we want them to achieve. So that's where the balanced scorecard comes into play, that we can set up a scheme, set up a framework for evaluating our employees that will provide incentive and provide direction for them to achieve the goals of the company. So let's start with that. So the balanced scorecard, really, we're talking about in this chapter, really performance management systems. And what that really means is how well are the employees or the units doing in meeting the goals of the company. So we're trying to evaluate the performance of either individuals or of specific units or divisions. And we're going to use metrics or measures to be able to evaluate, hopefully quantitatively, as to whether those goals are being met. So, for instance, in the financial performance area, one metric we could use for financial performance would be profitability. So we could look at profit as a metric that would be a measure of how well we're doing relative to financial performance. So we could use sales, we could use profit, cash flow, a number of other items. What we're going to do is basically talk more specifically about strategic performance measurement systems. And what we're really doing here is making sure that we align the system with our strategic objectives. So if we have objectives that we want to meet, our overall strategic objectives of the organization, that those are linked to the performance metrics, so that we don't just have a bunch of metrics or measures that are just kind of independent of one another, but that they're all linked to the specific strategic objectives that we've set for our company. So if we have objectives along different sort of areas of financial, customer, etc., that those metrics are aligned directly with those objectives, and we can measure the progress that we're making in achieving those objectives. So we want to make sure that those are linked together. So probably the most common strategic performance measurement system is the balanced scorecard. So if we talk about really setting up this performance measurement system that's linked to strategic objectives, what we're talking about most commonly is what we call a balanced scorecard. And I'm just going to abbreviate that as BSC. And the balanced scorecard is just what you think. It's a balanced sort of view of performance. It's from many different perspectives. It's not just financial. And the reason for the balanced scorecard and having these different perspectives is really to, right over here, is to encourage a more balanced view of performance. So we don't want people just focusing simply on profit. We want people focusing on a more balanced view of what it takes to be a first-class company. And so with respect to that, we've got 4 perspectives listed here. And of course, there can be more perspectives than this. These are kind of some standard perspectives. So what we would do is we would have some strategic objectives that would go along with these 4 perspectives. And then, of course, we would have metrics that would then measure against those objectives to see how well we're doing. So for instance, financial perspective, we're typically talking about sales, profit, return on investment, maybe cash flow, could be a number of other items. But your typical, financial sort of measures or perspective in terms of how well you're performing. Internal processes, here we're really talking about operational efficiencies. So again, streamlining processes, making sure that the process is as efficient as possible. There's less waste in the system. Again, inventories are managed and reduced, less waste, less costs. All of that is what would fall into that internal processes perspective. Learning and growth, a couple things. First of all, research and development, certainly creating innovation for the company. So relating to new products, new markets, things like that. So the innovative side of the company as well as the employee side of the company. So employee training, employee satisfaction, we'll just call that employee development. So again, a lot of metrics around that, making sure that we have a trained workforce that we can retain and who is obviously satisfied and happy to work there and will work hard for the company. And then probably the most important really perspective that drives all of this is the customer. And what we're talking about there is really very broadly is to be able to satisfy the customer. So this relates to customer satisfaction, customer being able to respond to customer needs, minimizing product defects, high quality products and services. So many different items that relate to having a customer that's satisfied, that will, number one, try the product, and number two, come back for repeat business. So let's see how this would come together in a balanced scorecard and how we would structure that scorecard. So first of all, we have a particular perspective. Let's just pick an easier one. So let's say that's our financial perspective. So from a financial perspective, we might have a strategic objective that says increase profit. So that could be the strategic objective. From there, what we have is we have, and actually let me change this a little bit. I think I have this wrong. So sorry about that. Just had to make a couple changes. So first of all, we have our metric, our performance metric. I'm sorry. We have our perspective, performance perspective. The first one we're just going to choose as an example, and that's financial. Again, we're going to link that to a strategic objective. In this case, we're going to say increase profitability. From there, we're going to have a couple different metrics or measures that we're going to use to determine whether that's happening. One might be, let's say, market share, under the idea that the stronger market share that you have, the greater pricing power you will have and the greater the profitability you will ultimately have. So market share would be one metric or one measure that you might look at. and the other one might just be the actual operating profit. So those are metrics to look at to see how well you're doing in terms of achieving your strategic objective of increasing your profit. And from there, we're going to use performance targets because we want to have something quantifiable to measure against. And let's say here that our market share target, let's say, is 10%, and that our operating profit target, let's say, is $85 million for the year. So that would be how our balanced scorecard would be set up. So we'd have, again, for one of our perspectives, which is financial, we might have a couple of different strategic objectives. Increased profit might be one of them. Increased sales might be another one of them. Increased return on investment could be another one of them, let's say. In particular, then we'd have a number of different metrics to measure whether those strategic objectives are being met. In this case, our market share targets being met, operating profit number being met, and then of course we'd have the actual targets themselves to measure against. So that would be an example of how we could use these, how the balanced scorecard would be structured and set up. Now, the one thing that's you can probably ask yourself, so how are we going to do all this? The one thing that, of course, would be missing would be these strategic initiatives, and that would fall in this section. In other words, what are we going to do to achieve those metrics, to achieve those strategic objectives? So, for instance, we might look at maybe cost reduction programs to increase profitability. So maybe we have an initiative there to reduce costs in a particular area. Maybe we have some new products that are going to increase our market share and increase our profitability. Maybe they're more innovative, command higher pricing. Oops, new products. So again, there could be a number of strategic initiatives that are being undertaken that would fall in this category between strategic objectives and the metrics that are going to help us achieve those objectives and will be able to be measured by these performance metrics and ultimately by the performance targets. So the strategic initiatives are a critical piece of the balanced scorecard, but they don't necessarily fall into the scorecard in detail. They're probably just listed as programs, and then the actual program and execution of that is probably a separate initiative that's undertaken by management. It's also important to understand the relationship between the performance metrics. So some are what we call leading indicators, and some are what we call lagging indicators. So for instance, a leading indicator would be an indicator that's predictive, that has some predictive power in terms of what will happen to another indicator. So an example here might be number of shipping errors. Okay, so shipping errors. If shipping errors are decreased, then customer satisfaction, however that's measured, could go up. So the error-free shipping is really a leading indicator for customers. We'll come back in part 2.